All right, good afternoon. Thanks everyone for joining. This is Building Foundations for Good Money Habits. My name is Carrie Schoner and I'm an advisor here at Private Vista and the host of today's webinar. Before we get started, I want to share just a little bit about Private Vista is a financial planning and wealth management firm in the Chicagoland area. We manage about $3 billion of assets for our clients who are located in 50 states. And we've got offices both downtown Chicago and in Oak Brook in the suburbs. I'm going to kick us off sharing just a couple of housekeeping items to ensure that everyone has a great webinar experience. You'll notice that you're going to be muted for the duration of the presentation. This is to ensure that everyone can hear our panelists clearly. Cameras are off and chat is disabled as we must adhere to compliance regulations. Some of you sent in some questions ahead of time, and if time permits, we're planning to go through those questions to answer them live at the end. Just to give you a little bit of background information about myself, I am a certified financial planner at Private Vista, and I've been with the firm for about 3 years. I have about 5 years of industry experience, and it's been awesome. I'm excited to moderate today with two of my truly fantastic colleagues, Colleen and Miles. So I'll go ahead and let them introduce themselves. Miles, why don't you kick us off?
All right, thanks, Carrie. Welcome, everyone. I'm Miles Johnson, a financial advisor with Private Vista. I've been doing this for about 7 years now, where I work with families and individuals to achieve financial independence. And my wife and I, in our free time, we spend most of our time raising our 3 kids. And we spend a lot of times outdoors with each other. And in my own free time, when I'm not watching my kids or raising them, I spend most of my time either working out with my workout group or you're going to find me on the golf course.
And my name is Colleen Lopez. I am in the industry for 10 years now, but I am new to Private Vista. I've been here for about 6 months, but have been having just a really good time with my colleagues. I'm looking forward to speaking with you all, hopefully meeting you all one day. In my free time, I like trying new restaurants. My husband and I also have a new puppy, so we have our hands full with that.
Awesome. Thank you both so much. We're going to go ahead and dive into our first topic of the day, which is all about how to be intentional with your money. So you're maybe in the very beginning stages of your career or at your, first job, first couple of jobs. How do you be intentional with the money that you're earning and make sure that you're making choices that are meaningful to you? So Miles, we'd love to hear your tips.
Yeah, so thanks, Carrie. I would say it really just starts off with, building that strong foundation comes from being intentional with your money. It's really a mindset shift from where when you're intentional with your money, you tell your money where to go rather than wondering where it went. So when you kind of break that down into the 2 pieces, telling your money where to go, it's a very proactive mindset. You're being diligent, you're directing money where to go. For example, every time you get a raise or a bonus, you take 10% of it and you go have fun with it. You spend it on whatever you want. And then the other 90% you diligently apply towards a goal that requires money to achieve. And then the second part of that is, wondering where money went. That's a reactive mindset. We like to stay away from that type of mindset. A good example of this is when you go to your credit card statement or you got your bonus that month and you go, wow, I spent that much on restaurants. We really try to stay away from that. So it's really important to remember that you're in control of your money and it's not the other way around. Another way said is you design your life, don't let life happen to you. So when you align your resources with the life you value most by, being diligent and having a plan, you're going to be more fulfilled and you're more likely to achieve your long-term goals and kind of stick with a plan because, you're having some fun along the way, but you're not going off the deep end in the sense of spending all your money for now versus saving just a little bit for later. Many people really don't realize, how important this mindset shift is and directing where dollars should go. And, when you start to notice, where your money's going and you're able to track these things through creating a spending plan and aligning, your money with stuff you like to do, this is a big mission here at Private Vista, is where we make sure that people, use their money meaningfully. And the best way we can do that is through building a budget, or we like to call it a spending plan, which is a spending plan is a very fundamental skill that develops over time, but it's like kind of the key to building wealth. Now, a lot of people get confused with income and wealth. And, there's a saying here, it's not how much you make, it's how much you keep. And the only people that get to are able to keep their money long term is they have a plan for it. So when you're starting with this spending plan, it's really important to remember that it's a skill. It's developed over time. This isn't something you just wake up one day and have mastered. Generally, it takes like 3 to 6 months to kind of flex this muscle, because the first 3 to 6 months, you're just trying to figure out where your baseline spending is. You're kind of what we call in the calibration phase of a spending plan. You're just starting this activity. You're just starting to watch where the money is going. Some bills don't come every month, so you're just getting used to things. So just be patient with yourself when you go to attempt something like this, and just know that it's going to take time, but over time, it's going to get so much easier, and you're going to get really comfortable with it. It's essentially like you're rolling a small snowball at the top of a mountain. It's not going to really go anywhere at first, but as it picks up momentum, things are really going to take off, and it's going to kind of essentially get to a point where it's on autopilot, where you kind of know what you're making every month. You have an idea what you spend. You kind of know if you have excess. And then sometimes when excess, like a bonus, comes in, you have a good idea where it's going to go next. It's going to go towards a short term, a medium, or like a long-term goal. So when you take the spending plan and you kind of break it into, we like to think about it in like 3 buckets. There's like 3 main categories. There's bucket 1, which is like long-term savings. This is a bucket where eventually someone, just starting out, we try to get them up to 15% savings as fast as we can. It might not be possible right out of the gate, but that is kind of an ideal target of how to, that's a good savings number to live your lifestyle today, but 30 years from now, how to maintain your lifestyle when you stop working for money and you're relying on your assets. 15% is kind of a good baseline of where you need to be saving. So that's kind of bucket number 1. And then bucket number 2 is, in a spending plan, is like your fixed cost. What are you spending on every month, whether you like it or not? It's kind of the basics, the 4 walls, rent, house, your insurance, any loans, utility bills, gas, groceries, like basic clothing. And then bucket 3 is the discretionary bucket. It's really the cost that you're in control of, where you can dial it up and down: restaurants, vacations, cars, technology expenses. And what we find with the clients that we've worked with, and just through years of experience doing this, is that the most successful clients or people tend to have a really good balance within these 3 buckets. And they save some, they spend some, and they control the discretionary bucket to what they actually have planned. But it's really important when you build a spending plan, especially in the discretionary bucket, is to give yourself permission to spend money on stuff that you like to do. For the reason being, you're going to stick to the plan longer. So when you build something with spending, think about something you like to do that brings you joy, and it's in your free time. For example, mine's golf. I could spend an unlimited amount of money in golf. And the reason I don't is because I have 3 kids to support, and we have other things and goals we're trying to achieve. But as long as I know I golf 2 times a month, and it give myself permission to spend that, I'm totally satisfied with that, because I've given myself permission to do that. I'm not just kind of winging it. But it aligns with a value that I really, that brings me joy, it brings me happiness. And again, it helps me stick to it. So another really common question we get is, how much house how much money should I spend on my house, or like how much rent can I afford? And when you're starting out, it's common for like this expense item to take up like 40% of your income. And over time, as your income rises and spending normalizes, it's going to get down to about 25%. What we kind of like to highlight this point is if you're over 40% of what your take-home pay is in rent or housing, you're going to definitely feel the stresses of not having any flexibility in your plan and really having like that discretionary like little fun bucket that you can do things with. And so it's kind of important. Maybe you are feeling this way, or maybe you're not, but it's a good round number to kind of say like, hey, this is kind of the top end of where we should be in housing, just so you can do other things with your money versus just locking it up in a rent payment.
That makes a lot of sense. This is all really, really helpful, Miles. I love your point about not feeling guilty about doing all the things you enjoy, as long as you're like keeping it to a certain percentage of your spending and, just being aware of it. I think that's really important. I also heard what you said about the goal of saving 15% of your gross income. So, you're saving 15%, you're maybe putting in a bank account. Do you have any recommendations around like an emergency fund, or how much people should have in their savings? Or, what are some rules of thumb around that aspect of this?
Yeah, absolutely, Carrie. But first, before we talk about how much, let's talk about exactly what an emergency fund is. And an emergency fund is a cash reserve that is earmarked for unplanned expenses and financial emergencies. This is not to be used when you overspend on discretionary items. It's essentially a buffer. It's a pile of money that sits in a checking account that doesn't bridge expenses. It's only for financial emergencies when you need it. So a good rule of thumb for how big this fund should be, it's about 6 months of your fixed expenses. So if you, again, like I called it bucket 2 earlier, your 4 walls, your basic living needs, take that number, multiply it by 6, you should have that in cash at all times. And the reason why is there's always going to be downsides in life. Someone gets sick, someone gets laid off, it's just for whatever reason, it seems life always gets in the way somehow, some way. So we like to say, give yourself a cushion. And, for some people, for some families, it could even be higher. Like a family that has, for example, a family that has one income source versus 2, they really rely on that one income source. So they might actually want a year's worth of cash. But this emergency fund, it's really not designed for long-term growth as far as the account itself. What it is it's a buffer to protect you from touching your other investments, your long-term investments for short-term needs. So what it does is it protects those and allows those assets to keep growing, which is what you want. And what we're going to talk about later is time and compounding of money is very important. And the emergency fund is like a key component to keeping that together. So like a good example of this would be, say you're saving $200 a month into your emergency fund, and you're coming up on the last month of having 6 months in cash in the emergency fund. And with that $200, you take it and you, instead of applying it again to the emergency fund because it's fulfilled, you take it to your car payment that was not, say it's $300 a month. You take that extra $200 and you throw it at your car payment, and you pay $500 a month towards the car, and you try to knock out the car. And then you kind of keep going like a snowball. Once the car payment's done, you take that $500 you were throwing towards the car, and you maybe say you have a student loan or another debt that's $500 a month. You pay the normal bill, and then you take that extra $500 you were paying and you pay it on top. And what you're doing is you're creating this snowball effect of freeing up cash flow to start using towards, like again, short-term, medium, long-term goals. In the end, it's in the process of it, it's kind of a grind in the sense, you could be doing so much more with this money, having fun, going on trips, but in the end, you're going to thank yourself for getting the financial cards in order, and having this what we call free cash flow, cash that's not going to bills, it's not going to, the basic living cost. You're going to have options. So when you do this for, a long period of time, you get to this point where you can start saying yes to things that you used to say no to all the time. And again, you just have options, you have flexibility. And it's really important to keep in mind that like the decisions that you're making now are going to influence the habits throughout your career. And as you get older and you have more responsibilities, it's about building good habits now. Maybe while you maybe don't have kids, or you're thinking about it, if you get these kind of cards in order correct now, you can definitely just, again, give yourself a little more breathing room, a little more flexibilities. But smart decisions like this, they compound over time, and they put you on the path to financial independence, where you get to that point where you don't have to work for money.
Thank you so much, Miles. That was all really helpful. I think being intentional with your money is so important to understand so that you can, like you said, align your resources with the kind of life you value most and get yourself started off on a really good foot in your 20s or 30s when you're maybe just at the beginning of this career trajectory or your savings journey. So thank you so much. We do want to move on to our next topic, which is all about investing. So we're going to talk about different types of investments. We're going to talk about different places to keep your investments. And Colleen Lopez is going to take it away and let us know how you can get started once you've got that emergency fund and you're ready to invest.
So Miles gave us some great background. Now, once you pay off your debt and build your emergency fund, the next question is, what do I do with my money? And the answer is investing. It's the easiest way and the best way to start building your wealth and focusing on what money will I have to spend in retirement when I'm no longer working for an income. So the first question, what are the different types of investments? The two most common categories is stocks and bonds. And a stock is a fractional ownership in a company. So think about a public company that makes shoes, for example. If they exceed their sales goals on selling these shoes, they in turn have a higher profit. From that directly impacts their earnings. So they have higher earnings, and that ends up transferring into their stock price. So you could have then a higher stock price. Bonds, for example, is where you are loaning that company money with the promise of the return on principal, as well as collecting interest along the way. So you could be a stockholder and a bondholder in the same company. Now, there are different risk profiles with investing in these two different types of investments as well. So when you purchase that individual stock, that's generally riskier than purchasing a bond, because stock performance depends on the performance of that company, which is harder to predict. The bond performance, that's something that when you are purchasing that bond investment, it's fixed, and you know that from the outset from when you purchase it. Now, there are two different types of vehicles for investing. So it can be an individual stock, for example, or it could be a mutual fund or an exchange traded fund. Now, you can have these two different types of vehicles for bonds as well, but let's just think about stocks for right now. So if you were to invest in that individual stock, think about a shoe company, for example. There are a couple pros. So one of the pros would be, you know what you have your investment is, and you have complete control over what you own because you picked it. You're able to follow that easily in the news. Some of the cons are it's time intensive to be able to do the research on that company. You also want to have a more diversified pool of assets, which we'll talk about in a little bit, but you wouldn't want all of your money just in that one shoe company. So it's a bit more research in looking into what other companies you'd like to hold. Also, it's risky where there's concentration in that investment. So like we said, you'd want to invest in more. A mutual fund or exchange traded fund, for example, generally these are similar in the sense that they have a basket of securities with a common goal or theme in mind. So an example would be the S&P 500. This is 500 of the largest companies in the United States into one investment or one mutual fund or ETF. One could also be small companies that invest in tech or something that's equities all world that encompasses all different countries and the biggest companies across the world. The pros for having a mutual fund or exchange traded fund is that you can have one investment and it's very diversified. It's also convenient. You only have to pick potentially one or less than you would if you did an individual stock. Some of the cons are that mutual funds, they trade once a day. So at the end of the close of business for the stock market. So if you were to want to trade something at a specific price, mutual funds are not your choice. That's where you'd like exchange traded funds. Those trade like equities. And then also the other con would be that there is a cost because as you purchase a mutual fund, there's a company that runs that fund that picks those investments for you, that does buys and sells in that investment. And that's at the end of the day going to cost you something. But all of those, you can find funds that are very low cost. You just have to do your research. And then with those investments, there's another thing to consider: active versus passive. Do you want them to track a benchmark? Or also, do you want to invest in a mutual fund or ETF where the goal is to beat that benchmark? Although that's not always the case. So that might add a little bit of risk to the type of investment. So using this kind of investment, these funds, is where you can spread your risk across a lot of different companies. So if a company has bad earnings, if that shoe company does have bad earnings, you aren't solely invested in that. Your retirement savings aren't impacted directly from that. One option, which you probably have seen if you're invested in a company 401k, is a target date fund. Now that is a mutual fund, and it's an investment vehicle that will adjust your asset allocation, which we can talk about in a minute, between stocks and bonds, depending on your age. So if I were 25 this year, retiring at age 65, I would pick a target date fund for 2065, and that would be more growth oriented, a much higher allocation to equities now, lower allocation to bonds, stocks versus bonds. And then as I get closer to retirement, it would increase my allocation to bonds, a more conservative fixed type of investment, and reduce my allocation to something a bit more risky or growth oriented, because we wouldn't want to retire in a year where there's kind of a down market. We'd much prefer being in something more conservative at that time.
This reminds me of that saying that you hear all the time that's like, don't put all your eggs in one basket, where you're trying to spread out your eggs so that they're not all, in one company, like your example.
Exactly. And that's a really good segue into talking about asset allocation, where if you think about being invested in a specific percentage of stocks and bonds, you'd think about a percentage in your equities, whether that's domestic, small companies, large companies, international companies. You'd want to look at that. And then you'd also look at your percentage that you're in bonds. And you'd really want to look at this allocation in terms of all of your accounts. We'll talk about each of the different types of accounts. But if you have two different retirement accounts, you'd want to combine that total together to really see what your overall asset allocation is. Again, higher allocation in equities, probably a bit riskier, depending on how much your allocation is to bonds. So once you've determined the types of investments you want to invest in, there are 3 different accounts that you'd want to look at and where to invest that money. So one of the types of accounts would be a brokerage account, which is where you might put your excess savings that you want to invest. So this account is taxed each year on income that you make, whether that's interest, dividends, or whether that's appreciation. If you decide to sell that shoe company at a loss or sell it at a gain, that would impact you on the next year's tax return. Another type of account would be a pre-tax IRA, or 401k. An IRA is an individual retirement account. You can do that on your own, whereas a 401k would be offered through your employer. So these are the most common when they are pre-tax. Contributions are made before the paycheck is taxed, or you can get a deduction on the front end, which is what happens if you contribute to an individual retirement account or IRA. Now, withdrawals are taxed in retirement. So although it's pre-tax on the front end, it's taxed at the end. And then also what's important for these retirement accounts to know is that you are penalized if you withdraw the funds before 59 and a half. So something to keep in mind, A, in terms of risk tolerance, B, in terms of can I part with this amount of money in my budget because I won't be able to touch it until I'm 59 and a half. And then also there's a Roth IRA and a Roth 401k where it's the same as what I just mentioned, but it's actually made after tax. So your contributions are after tax. You've already paid the tax on the front end. It grows tax-free, and then withdrawals are made tax-free because that tax was already paid up front. But again, keep in mind that with these retirement accounts, you cannot withdraw it penalty-free before age 59 and a half. So you might ask, what account is better? And it really depends on having a good mix. What's important for you and your needs at your current life stage. So you want to have money that's accessible to you, saving for goals before retirement, such as buying a house or buying a car. That would be a brokerage account. Now, retirement accounts, you can't touch this money. And there is a tax preferential treatment for both of those options, whether you want the tax preference on the front end or the back end. So that's something to keep in mind for what can I use, how can that benefit my taxes, whether I want the benefit now or I want the benefit later. And then I want this to grow as much as it can until I hit retirement. My personal recommendation would be to have some brokerage assets, some retirement assets, to have a good mix of the two, keeping in mind that emergency fund that Miles talked about earlier. Now, the bare minimum to invest in your retirement account would be making sure you get your company match. So most employers have a matching program where they match your retirement contributions, whether it's $100 for dollar your contribution or 50% of your contribution, up to a maximum portion of your salary, typically 3 or 6%. So you want to make sure you know what that match is and what you need to contribute to make sure you're able to get 100% of that match. It's essentially part of your compensation, free money. So you'll want to make sure you either go back and look at your hiring documents or talk to your HR manager to see what that match is and make sure you get it. Now, one thing to keep in mind with matches is that they vest over many years of service. So you might not have 100% access to it today if you were to walk away, leave your company. Your contributions are 100% vested at all times. Those are yours. But your company match could take 2, 4, 5 years for it to fully vest. So it might be important to just keep that date in mind. Now, we've gotten a good baseline about talking about how and where to invest. Now, it's important to note that investing doesn't come without risks. So the amount of risk you take should depend on how much time you have before you use that money. So keeping in mind that timing, whether it is for a car you're going to purchase next year, or whether it might be for a house that you might purchase in 10 or 15 years, it's important to have those goals in mind ahead of time. So a short-term goal we would define as something within the next 1 to 3 years. So you want the risk for saving for this to be in relatively low risk, which in turn might mean low return. But you'd rather know that your risk is low. You'd rather know that the amount of money you're taking out isn't out at a loss because of where the stock market might be at the time that you need that money. So keeping it in something that might be fixed income, it might be a bond, might even be cash, depending on how near term that is, keeping in mind that length until that goal. And then for a long-term goal, think about the retirement accounts we just talked about. or a house you might buy in 15 years, we'd recommend taking more risk if you have the risk appetite, if you're able to take on more risk, because you have a longer time horizon to need those funds. So if the market drops, you can wait that out until the market recovers. And that would be important as you want to invest. You want to make sure you're getting your maximum amount of growth. But to do that, it does come with some risk. But being able to wait that out really matters, and being able to have those longer term goals and have that investment growth. So additionally, you'd want to consider your comfortability, which is what I kind of talked about, and what's important. Can you wait for the market to recover, or will you feel nervous and want to sell your investments at a loss? So there's a saying that actually goes, you don't lose money until you sell. That's when you lock in that negative return. But if you invested it, it's down from your purchase price, you haven't lost money yet because you haven't sold. So you can just ride it out and wait for it to recover. And when you do so, many people think, and a lot of the synonyms would actually be, downturn, bear market, recession, correction. You might have heard all of this in the news. And what many investors think is, oh my gosh, we've never seen this before. And you know what? That happens every time. But on average, we see, especially with a lot of these companies, what you can call in statistics that bell curve. There's always a reversion to the mean depending on what side you are on that bell curve. So just keep in mind that the markets will always go back to their mean return. It just might take some time. And now Schwab put out an article and did some research on the S&P 500, and they were able to determine that declines over a 20-year period. So think about 2002 to 2021, a decline of at least 10% occurred in 10 out of the last 20 years. I mean, that blows my mind. That's 50% of the time there was a decline of at least 10%. And over that time period, the average pullback was 15%. But as you hear in the news, we continue to hit new market highs, but it just might take some time for that market to recover. And so despite these pullbacks, stocks still rose in most of those years. I mean, think about COVID, for example, where we had a negative 6 plus return in the market. But we actually ended the year positive, which was really surprising. So that does happen more often than you think. And so stocks rose in most of those years out of this data set, where in all but 3 years, they all ended in positive returns. So declines are a normal part of investing, and that's what we want to make sure we hit home about. But what we need to do is do the work on the front end, have a good investment plan together at the start, and then you can focus on the long term. Wait out those negative market cycles for when we've got positive returns.
Yeah, thanks, Colleen. Thanks for sharing some, key components of investing. So I just kind of wanted to highlight on investing and this thing called compound interest is what we're really, if there's one thing you could take away from today, is how to take advantage of this thing called compound interest. So what we're trying to, if we take what I said earlier about being intentional with your money and then creating your ability to save money into the stock market and let that money grow, compound interest, that's where compound interest comes into play. And Albert Einstein has actually called this the eighth wonder of the world. This is like the key to wealth generation. And compound interest relies on time. It's time in the market is where your wealth comes from. So that's why we've been so critical about being intentional early and often with your money, because the quicker you can get to money in the market in a large sum of it, that's where your wealth gets generated from. So I just wanted to kind of share a really small example of, compound interest. This is a glorified example, but let's just say we had a penny. We started on day one with a penny, and that penny doubled for every day for 30 days straight. So day one, it's 1 penny. Day two, it's 2 cents. Day 3 is 4 cents. Day 3 is 4 cents. Day 4 is 8 cents. But by day 22, it's just under $21,000. And then in the last 8 days, from days 22 to 30, that just under $21,000 turns into $5.36 million. So Carrie's got a good little slide here to kind of show how compound interest is portrayed over a long period of time and being consistent, and how early and often is very important.
All right, so I'm going to go ahead and pull up the slide. So we've got an example for you here where we can see 3 investors, Carrie, Miles, and Colleen, and their different investment choices. So in this example, Miles starts investing at age 35 and he invests until age 65. He contributes 10% of his salary for those 30 years. Then next we've got Colleen. She starts at age 25 and she stops at age 35. So she's got 10 years of saving 10% of her salary. Then finally, we've got me. I start at age 25 and I stop at age 65. So I've got 40 years of saving 10% of my salary. So looking at this from the onset, Colleen saves for 10 years, Miles for 30, me for 40. You would expect, looking at this, that Miles and I would maybe not have all that different of a balance, might be closer than where either of us would land with Colleen, just because we're saving for longer periods of time. But the example will really show you the power of compound interest and how this works. So we've got Miles starting at age 35 and ending at age 65, and he's got a little bit over $400,000. Next, we've got Colleen, and so she's got 10 years. She actually has more than Miles when she's 65, and that's because she started earlier. So her savings journey started when she was 25, not when she was 35 like Miles. So that extra 10 years gave her a little bit more power because there was more time for the interest to compound. Next, we've got me. And the really interesting thing here is that you'll see that between Miles and I, when we're each 65, I've got about double what he has. And I only saved for 10 more years than he saved. So those extra 10 years, because they were at the onset of my savings journey, that compound interest had a lot of power in it. So, this is a really powerful example to show you kind of how compound interest works. In this example, we're assuming that all 3 of us are starting out with a salary of $40,000. So by saving 10% of that each year, we're saving $4,000. And we're each earning a 7% average annual rate of return. So all of those things are important to point out, but this really shows the power of compound interest and why, if you save early, your investments are earning interest, you're getting paid dividends. And if those interests and dividends are reinvested into the market, it creates the snowball effect where you're really able to grow your wealth so that you can, have the retirement you want, or along the way, enjoy your life. Like Miles was saying, be able to meet those, medium-term, long-term financial goals. So now we're going to go ahead and move to a different segment of our webinar today. Before we move into the Q&A, Miles and Colleen, did you have any last thoughts you wanted to share on some of the tips that you had?
Yeah, Carrie. So I would just say right off the bat, save early, save often, but know why you're doing it. Like, kind of put the purpose in there. So you stick to the plan, whatever it is. Some people like to have, like, let's say like a vision board, like this is why they're saving that. For me, it's, I want to just know when I can stop working for money and just have the flexibility to do really whatever I want. For me, it's to achieve one of my goals is the golf in all 50 states and then golf, around in all 7 continents, if it was possible in Antarctica. But it just, early, often, be consistent, and honestly, don't let the peer pressure of what others are doing around you make those decisions for you.
And I would agree. I would say invest early. I would also recommend staying invested. Don't follow fads. Know that if you're hearing about someone's investment successes, they have failures that they're not telling you about.
That's a really good point. So we're going to go ahead now. Several of you sent in questions, and we want to make sure that we're able to get to as many of them as we can. So we're going to go ahead and start off with a question for Colleen. And that first question is, how would I decide if I want to invest in a Roth or a traditional 401k?
I love this question. So the answer is it doesn't matter. Save. So pick one and do it. But there are reasons why you would want to pick one over the other. And like we talked about, so if you're thinking again about the traditional 401k, again, that's pre-tax. When you're taxed on the back end, and your Roth, you are investing or you are contributing after tax, and you pull it out tax-free on the back end. So just wanted to define that again up front. So what you would choose is really based on how you feel today. I think some people can make the decision about today, or also make it about in retirement when they're making their withdrawals. So today, do I want my tax return? Do I have a need to make my tax return to get a refund or to have a lower amount due? Do I want my taxable income lower? The answer then would be to do a pre-tax traditional 401k contribution. If that's okay, hey, I'll pay a little bit of tax on the front end because I want my contributions to grow tax-free and be withdrawn tax-free, then I would recommend the Roth. I would say the Roth tends to be a bit more helpful in terms of deferring, paying the tax up front and then letting it all go tax-free. But some people just want to defer for other reasons, maybe need a bit more cash flow today. So that could be another reason why you'd want to do that. So either works, either option, you'll get your company match. So like we said, make sure you're doing that, make sure you're saving. You can't go wrong with either, but there are benefits to doing one over the other. Just depends on what life stage you're in.
Thank you. Yeah, those are all really good points. And I think a lot of employer plans will let you do a little bit of each too. So if you're someone who has reasons why you might want to do one or the other, you could potentially do a little bit of both, which could be nice too. So my next question is for Miles. How do I track my savings progress once I'm getting started on this savings plan journey that you talked about? And then how do I figure out my net worth? How does that factor into this larger discussion?
Sure. And so let's start with the savings progress. Let's say today you just don't even know where you're at. Take a look at your checking account right now and go look at the balance from 12 months ago and see where the balance, did it go up? Did it go down? And then take the second component of that and look at if you have a company retirement plan, see what you're saving in there. So say you saved $2,000 in your checking account and you saved $4,000 in your retirement plan, add that number together, so $6,000, and divide it by your income. That's kind of where you're at now. And as far as tracking the progress going forward, there's a lot of tools out there. I mean, there's all sorts of spending plan or budgeting softwares that kind of, where you can start creating a budget before, like months prior coming up, and you can kind of just tell your money to go where to go. You drop it in little buckets. You create the categories before the expenses come. So, and then you can just take another look in 6 months, maybe 12 months, and start forecasting, are you on track for that 15%, or are you on track for 10%? Gives you kind of a good idea of where you stand. And then as far as net worth, it's a pretty simple equation. It's what you own minus what you owe. That is your net worth. So what you own, any assets, minus what you owe, any debts, liability payments, net that out, and That is your net worth. And you can track that every year. You can track that every couple of years. And just, what you want to see is if it's going up to the right, just, growing a little bit at a time. But again, you want to see it growing consistently and often.
Thank you. Something you said is a really good segue into my next question for Colleen. If I'm someone that really hates tracking my expenses and knowing how much I spent on coffee or shopping or whatever it might be, if that's just like not my thing, do you have any tips as to how I can still stick to a budget or a savings plan and meet these savings goals without getting like down to the penny?
Yeah, so I would say in the most basic sense, if you wanted to look back at what did I do last year, how much did I save, you could look at the January 1st statement of your checking account and your December 31st statement of your checking account, assuming that your paychecks go in, your credit card payments and debt payments go out. Looking at the difference or the balance, that would be what you saved. But looking at each individual expense, there are a couple of different budgeting softwares like Miles touched on. I know Intuit has one called Simplify, and then I know Credit Karma also has another one. Both of those have, I think, a free and a paid version that you can look at where you would link up your credit cards and your asset statements if you wanted that as well. They would be able to then automatically group together your expenses where you don't have to and kind of give you a year-end summary. And then lastly, you could also just use your credit card statement. I bank with Bank of America. I know Chase does it as well, where it gives you that budgeting tool just within your bank app. So that's free in your bank app, something that you can use pretty easily and just use their automatic characterizations. Pretty close. Sometimes you'll have to do some customization, but if you're not interested, you don't have to, but that'll at least give you a good look at your budget.
Awesome. Thank you. My next question is on evaluating whether a 401k or an emergency fund should be priority. So if I have to choose between saving into my 401k and saving for my emergency fund, Miles, which one of those two things should take priority or should come first?
Yeah, although both are important, the emergency fund is step one. You got to have that built up first. And the big reason why is if you did not have an emergency fund and a financial emergency did come and all your assets are in a 401k, well, you have to go touch that 401k or IRA and pay taxes on the distribution at your ordinary income rate. Plus, if you're under the age of 59 and a half, you have to pay a 10% penalty. So let's say you're in the 12% bracket and you took a distribution out of your 401k. You're paying 12% on that amount. And then you're paying 10% on top. So it's like paying 22% or taking like a 22% loan on your money. And, versus if you had a emergency fund fully established, you could just touch the cash, typically no taxes because there's usually no gains in an emergency fund because it's in a cash-like instrument. And that way, you can let, again, the long-term investments grow once the emergency fund is established. It's the buffer of protection for everything else. It's kind of like one of the key building blocks of wealth is to have just some liquid cash, not too much, not too little, but it's step one when it comes to building wealth.
Awesome. Thank you. Next question is for Colleen. How often, assuming I have my emergency fund and now I have an investment portfolio, whether that's the brokerage account or a 401k or IRA, how often should I check in on my portfolio and on those accounts?
So I would recommend not checking in daily. Like we talked about, the markets move so frequently. Not wanting to be emotional about your investments is huge. And so just not looking every day is helpful. But you do want to track it. You want to make sure you're on track to complete your goals. So I would do a big, hard look at everything once a year. But I would also recommend maybe looking on a monthly or at least just quarterly basis, because let's say you decide, hey, I want to be 80% stocks and 20% bonds, that number can get skewed depending on whether stocks are doing really well and bonds aren't doing very well. Then you might end up with a drift of maybe 85-15 for your bonds, and then you might want to sell some equities, buy some stocks or fixed income to get back to your determined target. So I would say double checking every quarter and making sure that everything is on track would be a really good place to start.
Awesome, thank you. We're now at our final question, which I think is a really, really good one for our audience. A term that we hear a lot when we're starting out on these, this kind of financial savings journey is lifestyle creep. And, whenever people hear that, I feel like a lot of them will ask, well, what is that? Why is it so bad? And how do I avoid it? Miles, can you give us some tips?
Sure. So like lifestyle creep is essentially, as you get raises, like I said in like the very early part of this webinar, you just go ahead and spend it and you kind of wonder where the money went. Lifestyle creeps, that is, as your income goes up, so does your spending. And your savings kind of either remains flat or goes down. So we will, what we like to do or think about it this way is putting some safeguards, some automatic like savings in place. So for example, when there are a lot of 401k options have this auto 1% increase in your 401k plan, where every year your savings rate just automatically goes up 1%. So if you were saving 9% this year, next year it's going to be 10, and then 11, 12, and so on and so forth. If you don't have that option, another good way is to do auto like savings to your savings account the day after you get paid. So that way you can't even spend the money if you tried, unless you can spend it all in about 24 hours. But it's a good safeguard. It's automatic. Just set it and forget it. But don't give yourself the ability to, don't set the automatic deposit or transfer 2 weeks out, give you 2 weeks to spend it. Create some systems in place so essentially you don't have to think about it. And that's a really good, simple way just to kind of protect yourself from lifestyle creep.
Awesome. Thank you so much, Miles. I think those are really helpful ideas. So with that question, that does conclude our webinar for today. We really want to thank you all for taking this time to spend with us. I know your time is extremely valuable and you're all busy people with tons of stuff going on. So thank you for taking the time to chat with us today and learn some of these helpful tips. And we hope that you all have a really great day. We look forward to the next time we're connected. Thanks.